Most people think they already know what happened with Tesla's earnings. The headlines told you everything you wanted to hear. Record revenue, record cash flow, and a stock that slipped a few percent after hours. But here's the truth. Those numbers don't tell the real story. A company can post record sales and still get weaker every quarter. It can break delivery records and still destroy shareholder value. Tesla just proved it. There are two kinds of people watching this video right now. The fans who see every dip as a buying opportunity, and the realists who want to know what the numbers actually mean. If you're in the second group, you're in the right place. I don't trade off feelings, I trade off math. I sold my Tesla positions back in January when the fundamentals started breaking down. Margin shrinking, competition rising, and the story getting louder than the numbers. Since then, I've made better returns in companies with stronger margins and clearer growth. So here's the only question that matters right now. Is Tesla still a good investment? Or is it just a story? Stay with me because by the end of this breakdown, you'll know which side of that line you're standing on. Tesla's headline numbers look like progress. Revenue came in at just over $28 billion, up 12% year over year. Free cash flow hit $4 billion, one of the best quarters in company history. On paper, that sounds like strength, but when you strip away the polish, the cracks are obvious. Net income fell 37% from a year ago. Profit margins are sliding, not stabilizing. The net profit margin is just 6.3%, the lowest it's been since 2019. Revenue is still climbing, but Tesla is making less on every dollar it brings in. That's not operational excellence. That's a strain. This is what most people miss. Growth can hide weakness. Tesla is spending more to make less. Its R&D and AI expenses jumped sharply, and regulatory credit income, which padded profits in past quarters, is shrinking. That means the profit you see today isn't the kind that compounds. It's the kind that erodes. And yet, the story being sold is that everything's fine because free cash flow increased. But free cash flow alone doesn't equal financial health. When margins compress and costs rise faster than revenue, you're not building leverage, you're burning it. Tesla is still growing. But the quality of that growth is deteriorating. The numbers might make you feel good at first glance, but when you read them twice, they tell a different story. The takeaway is simple. Tesla's growth engine is still running, but it's leaking oil. Tesla didn't lose margins by accident. It gave them away. You can talk about record revenue all you want, but when gross margins drop from 27% last year to 18% now, that's not growth, that's decay. And it's not temporary, it's structural. Tesla is fighting a pricing war it started and can't win without sacrificing profit. They cut prices to keep volume moving. They blamed tariffs. They leaned on energy growth to soften the blow. But the truth is simple. Every dollar of revenue costs more than it used to. That's the opposite of progress. You don't need to be a Wall Street analyst to see it. Margins are the scorecard of discipline, and Tesla's score just got worse. It's spending more on R&D, more on AI, and still seeing lower operating leverage. Even with record deliveries, fixed cost absorption is falling. That means the business is working harder just to stand still. Everyone loves to say, Tesla's investing in the future. Sure, but investors don't get paid in potential. They get paid in profit. And right now, Tesla's profits are trending in the wrong direction. Let's be clear, a one-quarter miss isn't fatal, but a pattern of shrinking profitability is. That's not noise. That's the market telling you the moat is leaking. The takeaway, Tesla didn't stumble into weaker margins. It made a choice. It traded pricing power for volume, and that trade is killing the thing that made it special. Tesla's energy business is finally waking up. Deployments hit a record 12.5 gigawatt hours, up over 80% year over year, and gross profit from energy cracked the $1 billion mark for the first time ever. That's real growth. The Megapack factory in Shanghai is ramping. The new Megablock design cuts costs, and Tesla is proving it can scale beyond cars. On paper, this is the part of the business investors have been waiting for. But here's the truth. It's still not big enough to matter. Energy and services combined make up less than a quarter of Tesla's total revenue. The other 3/4 still come from cars, and that's where margins are falling. Energy is growing, yes, but it's not growing fast enough to carry the weight of a collapsing auto business. People love to say, Tesla isn't a car company. Fine, but if 75% of your revenue still depends on cars, the market will judge you like one. And right now, that side of the house is bleeding pricing power. Even if energy keeps compounding 30% a year, it's a slow grind to offset auto contraction. That's not a pivot, that's a balancing act. And balancing acts end the second gravity kicks in. The takeaway: Tesla's energy division is a legit business, not a side hustle, but it's not the engine driving the company, at least not yet. It's the spare battery keeping the lights on while the car starts to sputter. Tesla used to be untouchable, the cool kid of the auto world. Faster innovation, cleaner design, better technology, but that edge, it's dulling fast. The market doesn't wait for anyone, not even Elon Musk. In Asia, BYD is everywhere, and I mean everywhere. They're flooding markets with sub 30,000 EVs, while Tesla still hasn't committed to building one. That's not vision, that's hesitation, and hesitation kills momentum. In the US, legacy automakers finally figured out how to build EVs people actually want. They're cutting prices, improving interiors, and bundling tax credits that make Teslas look expensive again. The best EV on the market argument doesn't hold when your competition is matching range, speed, and design for less money. Tesla's other supposed weapon, full self-driving, still doesn't have a firm rollout date for true autonomy. It's better than it was, sure, but it's still supervised, and investors are getting tired of waiting for promises that keep getting pushed forward. That's not a moat, that's a mirage. Add in tariffs, rising R&D costs, and a CEO juggling more projects than a NASA flight deck, and it's easy to see what's happening. The gap Tesla once owned is closing from every direction. The takeaway: Tesla's no longer the only player with cutting-edge technology. The field caught up, and Tesla blinked. The company that used to define the EV race is now just trying to keep pace, and the longer it waits to launch a true mass-market car, the faster that lead disappears. Tesla's story isn't dead. It's just not the same story investors keep pretending it is. Let's talk facts. The company is still profitable, sitting on over $40 billion in cash, and scaling an energy business that's finally showing real traction. The brand is powerful, the engineering is elite, and the integration between hardware and software still gives Tesla a head start most automakers would kill for. That's the bull case. But here's the other side. Margins are shrinking, R&D spending is exploding, and the valuation, a PE over 250 for a company growing revenue in single digits. That's not innovation premium, that's belief priced as certainty. And belief without execution is risk. Tesla's moat is narrower now. The tech stack and vertical integration are still real advantages, but competitors have closed the gap. BYD and many others are scaling cheaper and faster. Legacy automakers are learning efficiency. In some markets, Tesla isn't the disruptor anymore. It's the premium brand trying to justify the markup. If you're investing for the long term, you need to decide what you're actually buying. The car company that's losing pricing power, or the AI energy platform that still hasn't proven it can scale profits. Right now, it's both, and that split makes it hard to value or trust. The bottom line, my thesis is neutral leaning bearish. Tesla doesn't meet my long-term criteria today. The fundamentals don't support the valuation, and the moat isn't wide enough to protect the story. I'm not shorting Tesla. I'm just not paying growth stock prices for a business acting like a manufacturer. Everyone wants to know if this is the dip to buy. It's not, at least not for me. I sold Tesla back in January when the fundamentals started breaking down. Margins were shrinking, costs were climbing, and competition was closing in fast. Since then, I've put that money into companies with stronger margins and clearer execution, and those bets are paying off. Tesla, meanwhile, is still fighting the same problems it had 9 months ago. Here's the real question. Is this business getting stronger every quarter? No. Are the numbers trending up across customers, contracts, revenue, and cash flow? Barely. Is the product becoming harder to compete with? Not anymore. Tesla is still a good company. It's just a risky stock. The fundamentals don't justify the valuation. The story is bigger than the math. And when that happens, the risk-reward skews against you. That doesn't mean the stock can't go up. It means the probability of pain is higher than most people want to admit. If you're holding Tesla long-term, fine, but it should be a small slice of a diversified portfolio, not the centerpiece, because this kind of stock doesn't crash gently. It snaps when sentiment flips. I'm staying out for now. I want to see real margin recovery, real cost discipline, and proof that the energy and AI bets can scale profitably. Until then, I'm watching, not buying. If you love Tesla for whatever the reason, you do you, boo. Just know what you're betting on. I'm betting on math, not emotion. Now let me ask you something. Who else is breaking down Tesla's earnings with zero hype, showing both sides of the investment, and giving you real execution strategies that actually make money? Nobody. That's why my accounts are up over $2.3 million this year. That's a 66% gain year to date. I'm not guessing, I'm executing, and it's not just me. Air Tractor took profits on 2 stocks, locking in over $10,000 and said it best. Don't get greedy. Take the meatball sandwich in the middle. Wreaks Havoc cleared more than $6,000 in one trade after applying our exact strategy, and To the Moon had $16,722 in realized profit. 6 trades, clean execution, zero hype. Inside my Patreon, you get real-time trade alerts, entries, exits, and the why behind every move, daily market breakdowns focused on what actually moves money, and access to the same strategies I use to scale 7-figure portfolios with discipline, plus a community of serious investors who are done chasing noise. It's only $30 a month. People blow that on lunch without thinking. This is the one thing that can actually pay you back. If you've been watching these videos and thinking I should join, this is your moment. Stop watching, start building, because you can scroll for another year or you can start getting results. But either way, don't say you weren't told.